Debt is a tool, but only if you understand exactly what you are agreeing to. Only 2% of venture capital funding goes to female founders. 2%. Before you sign anything, though, make sure you are clear on the terms. What is the interest rate? What is the repayment schedule? What happens if revenue dips in a given month? Grant capital is the least dilutive capital that exists. Hi, my name is Adenike. Welcome to Everything Funding, a series for consumer brand founders who are building something real and are ready to raise capital. In my last video, I ended on a question. Only 2% of venture capital funding goes to female founders. 2%. And I promise we will talk about why. And we will, but not in the way that you might expect. I'm tired of seeing this problem talked about over and over with no solutions attached. I want this channel to be somewhere you can come for actionable advice on how to actually run your fundraise. Everything that is typically gate-kept, I'm going to share it here. So yes, I will name the problems, but I will always be sharing the solutions too. I have sat in rooms where decisions were made on who to fund. I have been on both sides of that table. And what I can tell you is this. The honest answer behind that 2% is not just about bias, even though bias is real. It is also about the fact that a lot of founders are pitching venture capitalists when they actually need something else entirely, something that fits better, moves faster, and costs them less. I saw this firsthand when I was running a venture capital fund. Founders will approach me with businesses that were great and I genuinely believed in, but they were not a fit for the thesis or the mandate of my fund. There was nothing I could do. The problem was not the business, it was the fund that they were pitching. So before we talk about why the door is hard to open, I'm going to show you the full map, the funding options that exist for consumer brand founders who are ready to raise. Most founders only know a couple of them. Let's dive in. Before I go through them, let me assure you that you are in the right place. I'm an investor who has deployed over $10 million into more than 100 startups. If you're building a beauty brand, a food business, a fashion label, a wellness brand, anything where you make or sell a physical product directly to a consumer anywhere in the world, and you're at the point where you can see exactly where you want to go, but you can't get there at any meaningful speed without raising external capital. Maybe you have more demand than you can fulfill. Maybe there's a hire you can't make yet. Maybe a competitor is moving into your space and they just have more money to move faster than you right now. And you're trying to figure out what your options are. Then this video is for you. Here is something I need to say before we go through the options. The fundraising content you find online, the podcast, the articles, the accelerator advice, almost all of it defaults to venture capital. It assumes venture capital is the destination and works backwards from there. That is because the content was built by and for the tech industry. Software businesses have a very specific economic profile, low cost to scale, high margins, predictable recurring revenue, and venture capital was built around that model. Consumer brands, on the other hand, have a very different model. You have inventory, you have retail timelines, you have longer paths to exit, you build through community and trust and cultural relevance. Things that take time and that most traditional venture capital investors genuinely do not know how to value. So when you walk into a room full of people who fund SaaS companies and pitch them your beauty brand, and they tell you it is not a fit, that is not always about you. It is not because you're a failure or you're building the wrong business. It is structural. You are in the wrong room. And the answer is not just to find better rooms, although we'll talk about that. The answer is to understand every type of room that exists because some of them were built for exactly what you're doing. Let me walk you through them. The first option is grants. Grants are non-dilutive capital. You do not give up equity. You do not pay it back. I'll pause here to define what equity is. Every business has an ownership table. Equity is simply ownership in your business. When an investor gives you money, they take equity. They are buying a share of that ownership and they also become part owners of your business. Every country has grant programs for product businesses. Most founders never look for them. The starting point in any market is your national innovation agency or your government small business development body. On Google, search grants plus your sector plus your country. Set up Google Alerts and come back to it regularly because the programs often open and close. The catch is that grants take time to apply for, and reporting requirements once you receive them can be significant. The amounts also vary widely by program and by country, but they are typically enough to fund a development phase, a specific project, or a pilot phase. Here is why I'm starting here. Grant capital is the least dilutive capital that exists. You do not have to give away ownership in your business. If you can fund your next product development phase with a grant before you go to investors, your next fundraise will start from a position of strength rather than need. And that usually changes the dynamics of the conversation that you have with investors. Most founders don't focus on this, but I really, really think that you should consider it. One practical tip I have for you here: create an information bank for your business. Pull together your financials, your metrics, your company details, all the documents you would need for any application. Store them somewhere accessible. I recommend Dropbox or Google Drive. That way, whenever a grant opens that is relevant to you, you are not always starting from scratch. You're just filling in the form, leveraging the information that you've already put together. Grants are right for you if you're funding product development, a pilot, or specific innovation project, and you have the time to apply properly. The next option is debt. Debt means borrowing capital and repaying it with interest. No equity changes hands and there is no dilution. You keep full ownership of your business. I want to talk about this properly because it gets unfairly dismissed in founder circles. People treat it like something to be avoided, and it's not. For consumer brands specifically, the most relevant forms are bank business loans and asset backed lending, which means borrowing against physical assets you already have, your inventory, your purchase orders, or your receivables if you sell wholesale. If you have a confirmed order from a major retailer, for example, and you need capital to fulfill it, purchase order financing exists specifically for that situation. The retailer's order is the collateral, and you get the capital to produce. You repay when they pay you. If you have inventory sitting in a warehouse, inventory financing lets you borrow against it. Consumer brands are often better positioned for asset-backed debt than founders realize because, unlike software companies, you have physical assets. Leverage that. The honest constraints here: banks want to see trading history, usually at least 1 or 2 years, and consistent revenue. This is not a route for day one or the very early stages of building. But if you've been operating for over a year, it deserves a serious conversation with your bank or a specialist lender, and I think that you should look into it. Before you sign anything, though, make sure you are clear on the terms. What is the interest rate? What is the repayment schedule? What happens if revenue dips in a given month? Debt is a tool, but only if you understand exactly what you are agreeing to. Debt is right for you if you've been trading for at least a year, you have consistent revenue of physical assets, and you need capital without giving up ownership. The third option is revenue based financing. Revenue based finance is a flexible funding model where a business receives capital in exchange for a set percentage of its future monthly revenue. Basically, you pay a portion of your sales to the lender. Providers look at your revenue history. If you have consistent revenue, you can often qualify faster than on any other route on this list. And if you have a slow month, your repayment drops with it. There are no penalties for dips in revenue. The cost of this capital is higher than a traditional bank loan. You will pay a premium. But if you compare it to giving up equity or high interest rates, then this is the math that makes sense for a lot of consumer companies. Providers to look at include Clearco if you are US based and Wayflyer or Uncapped if you are based in the UK or Europe. Search revenue based financing alongside your country to find what is available in your markets. Revenue based financing is right for you if you have at least 12 months of consistent revenue and you need working capital for inventory or marketing without giving up equity. The fourth option is angel investors. An angel investor is an individual writing a personal check into your business in exchange for ownership. This is usually their own money. Angel networks exist in most major cities globally. These are groups of angels who come together to search out great deals and invest together. They are usually a Google search away. Beyond the generalist networks, there are angels who specifically back female founders and consumer businesses like Alma Angels. Finding the right angel investors is something I'm going to go deep on in a dedicated video because angel fundraising deserves a special conversation. Before we go further, I want to talk about friends and family, the people who know you and believe in you before anyone else does. Many founders get their angel funding from friends and family first. If you choose to do this, then you need to do it properly. Have a clear agreement in writing. Be honest about the risk. Mixing personal relationships with money can go wrong, but if you do it carefully, it's often the first and most accessible option. Now, here is a word of caution. Not everyone who calls themselves an angel investor is one. Watch out for red flags. Anyone asking for too much equity at the earliest stages is a red flag. Anyone wanting a board seat before you even have figured out the basics of your business is a red flag. Anyone asking for control provisions like signing off on every hire you make or needing to approve every business expense is a red flag. A genuine angel backs you and then gets out of the way. They might provide advice, make relevant introductions, and open doors, but they are not trying to control your decisions or be involved in day-to-day operations. One thing that is increasingly relevant for consumer brands specifically is the rise of celebrity angel investors. A lot of well-known figures are writing personal checks into consumer businesses. Topicals, the skincare brand, has Gabrielle Union, Kelly Rowland, and Jay-Z's Marcy Venture Partners as investors. Celebrity angel investors provide credibility, community access, and distribution that few angel investors can unlock. If you're open to it, the right celebrity investor can change your trajectory entirely, so it's worth considering. Another important thing to note if you are based in the UK is that angel investment comes with significant tax incentives called SEIS and EIS. These schemes mean that the government gives a generous tax write-off and they pay back a portion of what your investor puts in, which makes angels more willing to write early checks than you might expect. Leave a comment if you want me to do a full video on how exactly this works. If you are based outside the UK, you should look up what early stage investment incentives exist in your country. Most countries have something. Angel investment is right for you if you are at pre-revenue to early revenue stage, you need smaller amounts to hit your next milestone, and you want investors who can open doors for you as well as write checks. The fifth option is accelerators. Accelerators offer capital, program support, education, and network in exchange for a small equity stake. The best ones open significant doors: investor relationships, retail connections, and brand partnerships. The list goes on. For consumer brands, the ones worth knowing globally include Founders Factory, which has a consumer-specific track, Sephora Accelerates for beauty founders, and Y Combinator, which has backed consumer brands in the past, although it skews heavily toward tech. I want to be honest with you about the trade-off. A 3 to 6 month program while you're running a business is not nothing. The equity, typically 5 to 10% that you give away, is real dilution. And some accelerator demo days are full of SaaS investors who have no idea what to do with a beauty brand, for example. Before you apply to anything, ask yourself three things. Number one, what does their consumer brand portfolio look like? Number two, what specific investor relationships are they going to open for you? Number three, what have their graduates actually gone on to raise after the program? The equity is worth giving away if the room that they put you in is useful. It's not worth giving if the investors at demo day are not your investors or the program is not really tailored to consumer founders. I plan to do a dedicated video on accelerators and knowing how to position yourself for accelerators as a consumer founder, because there's a lot more to say than I want to cover in this short video. Accelerators are right for you if you're at a stage where structured support would accelerate you as much as capital, and the program has a clear consumer brand track record that you can verify. That is the first five: grants, debt, revenue based financing, angels, and accelerators. In part two, I'm covering the five routes most founders don't even consider: crowdfunding, family offices, strategic investors, private equity, and venture capital. And I'm walking you through exactly how to choose between all the options that I've mentioned. If you haven't subscribed yet, do it now. Part 2 is coming soon, and trust me, you don't want to miss it. Please share this video with someone who might need it, and leave a comment with any questions you have. See you in part 2.